If you cannot speak the language of money, the world will mute your dreams, and it starts with one choice at the checkout: credit or debit. In a world flooded with headlines that shout fear, one truth cuts through the noise. Money is a language. Those who learn to speak it fluently shape their future. Those who do not drift. Today, the terrain is hard. Wages have barely moved in a generation. In the lifetime of a popular financial voice, wages might have doubled, yet housing prices have leapt 9 times higher. A home loan comes with rates from 5 to 8%. The nation faces a shortage of more than 3 million homes. The math, for many, does not math, and yet, precisely when the landscape looks bleak, the most seasoned investors remind us. Be fearful when others are greedy, and greedy when others are fearful. This is not theory. It is the discipline to act when assets go on sale. In Austin, housing prices fell 30% in just a year after one purchase. In the frothiest days of digital art, one token sold for $60 million. Today, it sits near 19,000. At the peak, it felt invincible. In the trough, it feels abandoned. Real money is made when the streets run red, even when the blood is your own. It is a hard image, but an honest one. Opportunity often arrives disguised as discomfort. Before any move, learn the language. The average American reads at about a 6th grade level. The average American learns money only up to budgeting in high school. Balancing a checkbook once taught the basics. Today, the stakes are different. Consider the first word in that language: credit, not debit. Credit cards are dangerous if used as wants, not needs, if balances linger and rates compound. Yet debit cards are worse for those who aim to build wealth. A debit card does not build credit. It rarely pays points or perks. It leaves your money more exposed to fraud. When a credit card is compromised, 2 clicks can erase the false charges. When a debit card is drained, the bank points to your own account. In a system built on credit, good credit is the underpinning of wealth. Start early. A simple card from a major bank, paid in full every month, begins a track record. Debt is not a villain. Bad debt is. The richest leaders use leverage tied to assets, not to their home and not to their personal guarantees. Their debts sit on businesses designed to earn. In this light, debt is a tool, like a hammer. It builds when held with care. It destroys when swung without thought. Learn this distinction and the terrain opens. What about starting a business when capital feels scarce? The great barrier is not always money. It is knowledge of where money lives. The Small Business Administration runs grants that do not need repayment for qualifying founders. It runs loans that can cover 90% of a purchase price. Platforms exist where individuals fund small business debt. And beyond the tactics, there is a belief worth adopting. Money is everywhere. It is searching for people rare enough to work hard and direct it wisely. Keep your job as you build. Data across hundreds of founders show a 33% higher chance of success when a steady income supports the venture. Side hustles thrive when a salary keeps the mind calm. Walk away only when the inflow from the venture matches the cost of living. Inside a company, the path to earning more is not hidden. It begins with a question many never ask. How do I make this business money? Then measure it. If $100 comes in, how much remains as profit? If $20 remain, negotiate to keep 5 of those you add. Big corporations can be rigid, yet more often than not, money exists for those who can show how they earned it. Sometimes leaving early means abandoning the potential to learn to negotiate, to manage up, and to expand a role. In past eras, job hopping could raise pay 20%. Today, diagnosing and staying can lift compensation by as much as 25 to 50% when value becomes undeniable. The hustle myth crumbles under modern reality. If hard work alone built fortunes, the laundromat owner would earn what the titan of commerce earns each second. In the age of artificial intelligence, mid-level execution becomes common. Knowledge is abundant. Creativity and performance become scarce. The top performers work like lions. They sprint, recover, and sprint again. They deepen their unique stack of skills. They create in a world of mass production. Passive income, often sold as effortless riches, rarely exists in practice. Even a row of vending machines needs repairs. They break. They are raided. They demand time. On a grand scale, aggregated operations can perform well. But truly passive is a mirage. Instead, seek work that lights the fire and pays well. The boring, sexy matrix reveals a simple law. The more boring the industry, the more likely it is to pay consistently. In glamorous pursuits, the numbers expose a harsh truth. In one major union of actors, Roughly 187,000 members carry a card. More than 80% do not qualify for health insurance. Average incomes live near $23,000. Contrast that with finance, where most professionals earn their full income from the job. Follow passion, yes, but learn to love the game. The game pays when the role pays. Every game has rules. If the rules feel unfair, resentment grows and the game slips away. Monopoly requires a set to build houses, 4 houses to build a hotel. Social media has algorithms that reward certain behaviors, whether they feel fair or not. Respect the rules, learn them, play them with creativity. That discipline turns frustration into momentum. Then there is the mindset divide. Fixers and freeloaders. A fixer sees the leaky boat, finds the putty, bails the water, and gets to work. A freeloader points to the holes and waits. Profit hides inside problems. Each ugly issue is a map to money. Claim responsibility and the ability to fix rises with it. Choose the rocket ship over the minivan. High growth creates turbulence. Systems break. People struggle. Yet rockets go to the moon. If you want the destination, accept the shake. External signals reveal the economic pulse in surprising ways. After a national tragedy and a market crash, one company saw lipstick sales rise 11%. When big luxuries become harder to justify, small luxuries increase. The lipstick theory suggests fear changes what people buy, not whether they buy. Look for the clues others miss. Another signal emerges in the home. Married couples tend to earn more. On average, they make more than 30% above singles, and their net worth often grows to nearly 3 times as much over a lifetime. The reasons vary from focus to stability. The insight is practical. Prioritize partnership if it matches your values. Respect matters deeply, and talk money early. A prenuptial agreement forces hard conversations. It clarifies what is yours, what is mine, and what is ours. It tests alignment before the stakes rise. When investing begins, the path is simple. Stage 1 is you. The highest returning asset class is the skill set and knowledge inside your own mind. Invest in learning first. Stage 2 is the broad market. The S&P 500 index offers low-cost access to the economy at scale. Use platforms that set diversified portfolios automatically. For a middle-aged saver, a 60-40 balance between stocks and bonds can make sense. For the young, 80-20 nudges risk toward growth. Stage 3 is private. Alternative assets, private equity, real estate, and commodities require more skill. Options and day trading are for professionals, not for shortcuts. Stage 4 is ownership. Become the company. Build the value others invest in, and let compounding over years do its work. Inflation makes this urgent. $100 preserved in a drawer since the 70s would buy about $25 worth today. Money loses value over time unless it is put to work. Pay yourself first. Set automatic transfers. 10% of income after tax flowing into investments every month beats inflation and builds discipline. Habits create wealth more reliably than hype. Guard against cultural traps that erode your future. The internet floods feeds with luxury. Festivals showcase outfits, flights, and tickets. The public assumes are paid with cash. The quiet truth is that many influencers receive free tickets, free travel, and free fashion, and they are paid to post. This year, buy now, pay later, plans appeared for major tickets. Roughly 64% of main ticket holders could not afford their ticket up front. Meanwhile, credit card debt lasts far longer than a day in the sun. Do not trade lifelong payments for a momentary post. Risk is necessary, but it can be intelligent. High reward with low risk is rare yet possible when you find a hairy problem with manageable exposure. The Small Business Administration reports a sobering fact. More small businesses close each year than open. Risk off sounds safe, but it starves creation. Choose hair with care, learn the rules, respect the data, take the shot. Money is immoral. It amplifies the person who holds it. In good hands, it builds schools, saves jobs, and supports families. In careless hands, it destroys. Speak its language. Credit before debit. Leverage as a tool, not a trap. Fear is the sign that a sale is underway. Be a fixer. Love the game, respect the rules. Pay yourself first. And remember, the world does not mute those who learn to speak.